All right, let's talk about NIO. The electric vehicle maker just hit some pretty serious turbulence, and that has everyone asking, is it time to bail, or is this the moment to buy the dip? Well, we're going to break down a technical analysis report to see what the charts are really telling us. Let's dive in.
So why all the chatter? Well, NIO's stock took a sharp dive in October, dropping nearly 16%. And this was just weeks after hitting a 52-week high. A pullback that steep is always going to get people talking.
And that right there is the big question for this whole analysis. Is this drop a major red flag telling us to run for the hills, or is it one of those classic buy the dip opportunities? The technical indicators are telling a really fascinating story here, with two completely different sides.
To really get what's going on, first, we need to map out the battlefield. Let's look at the key price levels that are basically defining this tug-of-war between the buyers and the sellers.
Okay, so at the time of this analysis, NIO closed at $6.75. Think of this as our starting point, our baseline for everything else we're about to look at.
Now here's our first really critical number, 659. The report flags this as the key support level. You can think of it like a floor, right? It's the price point where buyers have jumped in before to prop the stock up, and analysts are watching very, very closely to see if that floor holds.
And on the flip side, you've got 684. This is the resistance level, basically the ceiling. For the stock to show any real sign of life, it has got to punch through this level. So the whole fight is happening in that tight little range between 659 and 684.
All right, with that battlefield set, let's look at the first side of this fight, the case for being cautious. The report points out a few bearish warning signs that suggest this weakness might not be over just yet. One of the big tools for spotting this kind of thing is moving averages. It's pretty simple, really. They just smooth out the day-to-day price noise to show you the bigger trend. And if a stock's current price is trading below its recent average, well, that can be a signal of a short-term downtrend.
And yep, that is exactly what we're seeing with NIO. The report is clear. The price is currently sitting below its key short-term moving averages. This is a textbook bearish signal, and it suggests that the recent downward push still has all the momentum.
And here's what that looks like visually. See that? The current price is lagging behind where it's been trading on average. That gap is basically a picture of the downward pressure the stock is under right now. For anyone bullish on NIO, that is a clear red flag.
But hold on, that's only one side of the coin. The report also found some pretty powerful signals that are pointing in the exact opposite direction. So now, let's flip it and look at the bullish case, the indicators that suggest NIO might actually be ready for a nice rebound.
And the key idea here is the word oversold. It's kind of like a rubber band. If you stretch it too far one way, what happens? It's going to snap back, right? Well, in trading, when a stock falls too far too fast, it can hit what's called an oversold condition, which just means it might be primed for a bounce.
And the data here really seems to back that up. Check it out. Key momentum indicators, the stochastic and the CCI, are both deep in oversold territory. It's almost like the chart itself is shouting that the sellers might be running out of steam.
So you see what's happening here, right? It's a total technical tug-of-war. In one corner, you've got the bearish signals, like the price dipping below those moving averages, waving a big old red flag. But in the other corner, you've got these bullish signals, multiple indicators basically screaming that the stock is oversold and a bounce is just around the corner. So which side is going to win?
And that brings us to the verdict. After looking at all this conflicting evidence, the report actually comes down to a very specific conclusion. It even proposes exactly what to do in the short term. And here it is. The final recommendation is buy on oversold. What the analysts are saying here is that they believe those powerful oversold signals are more important than the short-term downtrend. They are betting on that rubber band snapping back. And they don't just say, hey, go buy it. They lay out a very precise plan. Step 1, try to get in near that key support level we talked about. Step 2, aim for a rebound back up to that resistance ceiling. But, and this is probably the most important part, Step 3, manage your risk. They recommend a stop loss, which is just an automatic escape hatch if the trade goes south. It's all about protecting yourself.
But of course, no analysis is a crystal ball, right? So to give us the full picture, the report is also super clear about the potential risks and the main takeaway from all this data.
Now, there are definitely risks to keep an eye on. If that support floor at 659 breaks, the stock could easily slide further down to its recent low of 628. And you can't ignore the bigger picture stuff either, like the insane competition in the EV market and, of course, the huge impact of Chinese economic policy.
So what's the bottom line here? When you weigh everything, the technicals seem to be pointing toward a short-term bounce for NIO, mostly because of how oversold it is. But, and it's a big but, this is a high-risk, high-reward kind of setup. That downside is very, very real.
And that really leaves us with the final and maybe the most important question of all. Look, this entire breakdown was all about short-term chart patterns. But for anyone thinking long-term, the real question is whether the company's fundamentals, its sales, its profits, its technology, can actually justify a true lasting recovery. And that's a question that charts alone just can't answer. Thanks for joining me for this breakdown.